welcome to the Legal Insight podcast by HHQ, where we help you unpack the world of law, business, tech, and more. And today we're actually recording episode 19 of season 2 of the podcast. And I would like to take this moment actually to stop and say what a huge congratulations to you guys for winning Fintech Law Firm of the Year at the Malaysia ALB Law Awards 2025 again. So for 2 years in a row. What's happening, guys?
Thank you so much.
Yeah, and like this year, I understand that you were facing like some giants as well. So
Yes, correct.
it just makes the win sweeter, right?
Yeah.
So Johnson, like, how do you feel about winning it twice in a row?
Well, it's a privilege, and when I say it's privilege, I really meant it. Because let's say, we all know that both Khai and I, we are young lawyers. And also, actually, we are standing on the shoulders of legal giants. Mm-hmm. And because of these senior lawyers, they actually have really built a strong foundation, especially in the legal industry. So I think that what we are doing, we are only given this opportunity for us to contribute, for us to really just do something to the legal industry. So I would say that the journey is extremely fulfilling. The journey is very satisfying. It's actually more fulfilling than getting the award itself. So I would say that it is a privilege that we will never take it for granted.
Wonderful, Johnson. How about yourself, Khai? I mean, like Johnson said, standing on legal giants.
Yeah.
How do you feel about the win?
Well, I definitely see it as a win for the industry, not just for us. It actually shows that the industry, fintech industry itself, is moving and it's also improving, right? There are going to be more regulation this year. In today's episode, we're going to talk about this new fintech regulation, right? I will not shed more details. But I think really the award is a testament to the hard work that not just Johnson and myself put in, but also the team and also the trust that our client has put in us. Yeah, we really appreciate all these things.
That's fantastic to hear. Congratulations once again, guys.
Thank you.
Thanks a lot.
Now, since we're already on the topic of fintech, today's discussion just couldn't be more timely, right? We're going to tackle one of the biggest legal developments that's really shaken the fintech industry or is going to shake up the legal industry and the tech space. Now, that's none other than the Consumer Credit Bill 2025. Now, the bill hasn't been passed into law yet, but we understand it's going to happen very soon. But it's already sent ripple in the industry. Now, in fact, your team, I understand, has already received like multiple inquiries from fintech companies and the like since the bill was tabled. Now, given how important and wide-ranging this bill is, we've decided to split this coverage into two parts. Now, in today's first episode, we'll lay the big picture foundation, which is what the Consumer Credit Bill is all about, what it governs, and some key concepts from the bill itself. And then in the next episode, in part 2, we'll zoom in on the critical legal issues and key takeaways that fintech companies like yours should watch out for. Okay, so let's dive right in. Johnson, tell us a bit more about the Consumer Credit Bill itself. Like, it's crazy thick.
Yeah.
Again, like another crazy thick. I think every year you get at least one crazy thick bill to read, and lawyers like you and Khai actually sit down to read it cover to cover. How long did it take you to finish it? And could you just help us break it down simply, like what it is all about? Because we have no patience to read the whole thing.
Yeah, you're right. Looking at the bill itself, the Consumer Credit Bill 2025, I would say that it's rather dense, it's rather thick. Yeah. And I think that it takes us, for me, it takes me close to a week for me to really read it cover to cover, to really understand what does it cover and then what does it try to actually govern or try to regulate. So I would say that the key intentions of this credit consumer bill is to really govern and to regulate the consumer credit space, because as we all know, the consumer credit space, especially those operated by the fintech companies, it has always been a wild west. So for example, in the past, we have been seeing some very crazy, some ridiculous buy now pay later scheme in which has really raised some eyebrows. So I think that the key intention of this particular consumer credit bill is to really provide certain coverage regulations to really safeguard the legal interests of the consumers as well. I think that this is creating a good balance in ensuring that fintech space is able to evolve, able to transform.
That's brilliant. Now, Khai, what are your thoughts on the bill itself? Like, why is it such a big deal, and why was there a push towards this direction in the first place?
Thank you, Zach, for the questions. So essentially, I think the way I see it is this bill is important because its objective is here to really protect the consumer from all this credit packages, from all these loan packages, essentially, that are being offered to them left, right, and center, right? So Johnson mentioned just now the space is Wild Wild West. So a lot of the consumer credit provider, BNPL, factoring, leasing, they have been operating without strict regulations. So they can just set the terms, whatever terms that they want, payment terms, term charges, interest rate, whatever. No one is telling them, hey, your interest rate is too high. Hey, your term charges is not favorable, right? They can basically call the shots any way that they want. And who is facing the brunt of all these issues? Consumers, right? Consumers who thought that they are getting a better deal by being able to break down their purchases into smaller tranches of payment. So they thought that they actually are the winner, but turns out it's actually not. It's actually the credit service providers and the credit businesses that are getting the last laugh here. So the bill is here to set the tone and tell all these service providers and credit providers that, hey, we understand that you're providing all these businesses, all these services as a business. You want to make profit out of it, but you need to operate within a parameter, a safe and reasonable parameter where consumer wins and you also win. So that's why I think we see this as a growth for the industry, for there to be a guardrail for these service providers to operate within.
Oh, that's amazing. Thanks, Khai. Yeah, we saw on the news that actually you can actually buy fried chicken or like
That's ridiculous.
fast food.
Well, that's the best.
in 3 installments.
Look at it.
Well, by the time I finish paying off my meal, right, I have digested it and probably excreted it out already.
Exactly. What happened to the good old days of saving up for fried chicken?
Well, no one is saving anymore. It's you live today and then you spend today.
Yeah. I remember when I was a student and I couldn't qualify for a credit card. Like to buy something that I really wanted, I had to kind of save up for it.
Right now, who needs a credit card? Buy now, pay later.
Yeah, who needs credit cards nowadays? Now, Johnson, one thing that's been creating a lot of confusion among the fintech players is how the bill treats different types of credit businesses, specifically things like buy now, pay later, invoice factoring, and equipment leasing. Now, let's perhaps start with the basics. Could you explain what BNPL or buy now, pay later actually is under the bill itself?
Of course. So let's start with something that's most interesting. I would say that is buy now, pay later will be the fundamental when it comes to consumer credit space, especially in this particular space, because most of the fintech companies, when they're actually providing fintech consumer credits, buy now, pay later, I would say that will be their key offerings. So in the very layman term, so without going into the technicalities, buy now, pay later essentially it concerns 3 parties. Number one is a third-party credit provider. The second one is a buyer and the seller. So the third-party credit provider, I will be providing a credit to the consumer. So let's say you want to buy a piece of fried chicken and then you do not have money. So right now I'll be providing you the credits so that you can be getting your delicious fried chicken. And then in return, you are going to repay me for the credit that I provided you. So what is really special about this buy now, pay later definition that's actually being drafted inside the bill is that it must concern 3 parties. So in the situation that you mentioned earlier, so let's say right now you are the fried chicken boss, and then you are the one actually providing the buy now, pay later offering because you are the one providing the credit. In that case, there's only 2 parties because you're the boss, at the same time you are the provider. So there isn't a third party involved. So if we are applying a literal interpretation, you will not be caught under this definition because it must have 3 parties. So if you ask me as a legal practitioner, I have my comments, I have my reservations towards this particular definition. But of course, this is how the bill is being drafted now. I think that we have to take a see and wait approach to see whether the buy now, pay later approach is going to be actually be broadened to cover more situations as well. Because at this moment, it's going to be quite narrow. It must concern 3 parties. And then we all know in many situations, whereas the buy now, pay later may only be concerning 2 parties, whereas it's only the seller and the consumer.
Now, immediately alarms are ringing off. Like
that's right.
There will be a lot of issues coming up. But let's turn to you, Khai. Like, do you think the definition of BNPL is actually broad enough? And we're seeing so many crazy versions of BNPL in Malaysia now. Okay, fried chicken is just one of the examples, but there's so many iterations of it. I think last year there was actually only 12 BNPL players, proper BNPL players. This year, who knows how many?
So I think you asked me whether the definition is broad enough, and I think hearing Johnson's response just now, I would think that his view is it may not be as broad as it should be. But at the same time, my view is that I think it's broad enough for now. And I think that it's intentionally drafted this way, like how Johnson has very well put it, right? It needs three parties in a transaction for it to fall into the definition of a BNPL arrangement under the Consumer Credit Bill. So in a case where the seller himself is offering the credit, long credit terms or installment terms, then it will not fall under the definition of BNPL. Why? Because it is then a credit sale, which is regulated under different legislation altogether. So I think the way this bill is being drafted is because they want to take into consideration the existing bill out there that regulates credit sale, and they don't want to basically mess things up too much. But I suppose in the next few years or the next few months, there may be a consolidation, right? That's something that I expect to happen.
Yeah, that actually makes sense. Now, moving beyond BNPL, right? It's the Consumer Credit Bill, it's not the BNPL bill, right? Could you also help us explain what invoice factoring is under the Consumer Credit Bill 2025?
Thanks, Zach, for this question. So, factoring is another key element or other key subject of regulations under the Consumer Credit Bill, just like BNPL. And I think factoring is a service that many credit provider has been providing in the past. But under the definition of Consumer Credit Bill, it actually means an arrangement where a third-party credit provider, either number one, you buy from the seller its accounts receivable. So whatever current and future receivables that the seller is expecting to receive, the credit provider will buy over and take over the credit risk. So number two, factoring can also be advancement given by a credit provider to a seller in relation to a particular buyer's accounts payable. So you are identifying the buyer upfront already, and this buyer is owing the seller X amount of money, right? And it's payable in maybe 60 days or 90 days. So instead of the seller wait it out for the full 60 days or 90 days credit term, the credit provider will actually take over the accounts payable and allow the seller to receive the money upfront. So essentially, these two arrangements are what is being defined under factoring definition in the Consumer Credit Bill.
Right. Okay, interesting. Got it. Now, Johnson, from a layman's perspective, factoring sounds very eerily similar to BNPL. Now, both involve some kind of credit and some kind of delayed payments. If someone's listening to it today and they're confused between BNPL and factoring, how would you actually explain the key differences between these two similar monsters?
Yeah, there is a very, very good point. So if you're listening out there and then you get a bit confused towards a buy now pay later scheme and also factoring scheme, don't feel bad about it. Because to be honest, even our fintech clients and even us, legal practitioner, we also tend to get a bit confused when it comes to buy now pay later and also invoice factoring. The key difference is because it looks very similar after all if you are looking at the transaction as a whole. But I would say that the main difference between these two is that buy now pay later, it concerns one key thing, which is the third-party credit provider. They are providing a credit to the purchaser. So I would say that for laymen that's usually listening out there, the key difference between buy now pay later and also invoice factoring, or we call it factoring, is that buy now pay later is about the third-party credit provider. They are actually providing you a credit so that you can be buying your favorite sneaker, buying your favorites fried chicken or anything else. Whereas for factoring, it does not really concern the credit that much. It's about the account. So as mentioned by Khai earlier, so for factoring, it's either me purchasing the seller's account, or otherwise, I'm actually advising payment for the seller. So one is concerning about the credit, the other one is about the account.
I think one telltale sign is we have to ask who is getting the benefit of the credit here. In a BNPL arrangement, technically, I think we can say that it's the buyer that's getting the benefit of the credit. Right? Essentially, and then if there's any administrative fee or any markup, it is to be borne by the buyer. Whereas in an invoice factoring arrangement or a factoring arrangement, regardless of which way, option A or option B, whichever way that you do it, it is typically the seller that will bear the administrative fee of the credit provider here. And it's not the buyer, because credit is getting money upfront without having to bear the credit risk or the payment terms.
That's right. I was going to say, like, from a consumer's perspective, both might look the same because I'm just
Yes,
buying it with
correct.
future money.
Yeah. But the effect to the buyer is different.
Mm-hmm.
One has some effect on the buyer because the buyer has to pay a little bit more in a BNPL arrangement, whereas in a factoring arrangement, buyer pays the same amount, typically, right?
Yeah.
And it's the seller that has to bear the markup in a sense, or rather, instead of getting 100% of the receivable, they are getting 98% or 95% of it
Thanks.
in exchange for immediate payment.
Yeah.
That's pretty clear. Hopefully, we're able to design some infographic that comes up here and it'll be all clear. Now, Khai, another key or the final key business type that's being regulated under this bill is equipment leasing.
Yeah.
I'm not very familiar about this. Like, so could you actually walk us through what that means under this bill?
Yeah. It's not. I think when we hear the word lease or leasing, immediately we will think of leasing a space, leasing a real estate, right? But in the context of consumer credit bill, it's actually not. It's actually leasing of movable assets, stuff like your laptop, your printing machines in your office, right? So these are typically the subject or the items that are subject to an equipment leasing. Essentially, it is an option or an arrangement whereby instead of you paying for the full purchase price of a printing machine, for example, you are breaking it down into, say, 36 months. You are paying it across a longer period. And at the end of the payment term, you get an option, or you may not get an option, to purchase the movable assets as to own it essentially. So leasing in the context of consumer credit bill deals with equipment leasing of movable assets and not land.
Yeah.
Right. And this was previously regulated or unregulated?
Previously was unregulated, but it's something that many people are providing. And the reason why I say printing machine is because I'm pretty sure that a lot of the offices out there, your machines are under an equipment leasing. And in fact, I believe the cuckoo, your household water machine is also under a leasing plan.
Yes,
you're actually paying to own over a long period of time, and typically service provider will bundle it together with, say, maintenance, service fees. Yeah,
everything is a subscription these days.
Yes, that's right. Cash flow is everything.
Right. Now, finally, Johnson, for those operating these BNPL leasing or invoice factoring businesses, can you give us a sneak preview, right, before we get into the technicals in the next episode? Can you let us know today whether they would need a license to operate and what happens if they operate without a license once the bill is being passed?
Okay, I mean, just a sneak peek.
Yeah.
So assuming the consumer credit bill turns into law, and then if you are listening out there, you're operating a buy now pay later services or otherwise leasing or factoring business, then the moment the bill turns into law, that according to the bill itself, you would need to operate with a license. And the consequence of actually operating without a license, I would say that is extremely severe. And how severe it is, we are talking about jail terms and also financial penalty. Financial penalty, if upon conviction, you're actually looking at a fine of up to 5 million and an imprisonment of up to 5 years or otherwise both. So just think about it. Just because you are actually right now providing a buy now pay later services, or as mentioned by Khai, just because you're providing equipment leasing, just to lease out printer, just to lease out a water machine and whatnot, and just because you're operating without a license, and then you're in jail for 5 years. So this is why we have been saying that the fintech space is going to be heavily transformed the moment this particular bill is being enacted into law.
Thanks, Johnson. And thank you, Khai. This has been a fantastic start in helping us today understand the Consumer Credit Bill 2025. You've heard it here first on the Legal Insight podcast from our two gentlemen here, the Fintech Law Firm of the Year 2025. Now, today we've laid down the groundwork, understanding what the law is, trying to regulate, and how different business models are being classified according to the bill. Now, in our next episode, we'll go even deeper into key legal insights, issues, actionable takeaways for fintech companies. So stay tuned for that episode. Now, until next time, this has been the Legal Insight podcast by HHQ. We'll see you in the next episode.